Unless you've been living under a rock lately, you must have seen the stock market crash and bouncing all over the place. Well, indices have fallen steeply but also bounced back temporarily, but only to fall further down again, multiple times. So what's going on and what can you do about it? Stay tuned to find out. And if you're new to this channel and enjoy the video, please remember to like and subscribe. So, the crash people have been foretelling us for years is finally here, it seems. After a decade of remarkable growth, the stock market finally took a dip. While cyclical adjustments are common and usually occur over a long period of growth, what is interesting this time is, unlike the 2008 recession, this market crash was not completely unforeseen. There are a number of compounding factors which prep the markets for this downturn, starting with the unusually high appreciation in stock market prices. This drove up the price-earning ratio, and remember, we want good value for money stock, and hence we want the price to be low and earnings to be high, that is, a low PE ratio. The issue here is that prices were rising faster than earnings. Furthermore, the stock market appreciation has been nothing short of stellar. Since the last recession in 2008, the S&P 500 index has risen from just below 800 to 3,400, more than quadruple its value over a period slightly longer than 10 years. On the other hand, economic growth has not been as spectacular as the stock market returns, and therefore this hints to some sort of bubble. So why did I say earlier that a crash was not completely unforeseen? Well, in recent years, the political and economic landscape has also changed unfavorably. The trade war between China and the US affected $400 billion of goods and has had a direct negative impact on manufacturing. In Europe, Brexit had created lots of uncertainties and held back investment as UK had its own political crisis. With interest rates having been at record low levels, debt levels both at household and corporate level were on the rise, therefore putting the economy at risk. However, the strong forces holding off recession were employment rates and consumer spending. As long as consumers were spending money, this would be fueling the economy sufficiently to counterbalance the negative events mentioned earlier. However, the coronavirus has thrown a spanner in the works at the worst possible times. As the virus is highly contagious and lockdown measures put in place, businesses have suffered directly from these measures. The two pillars were holding the economy have now collapsed. Consumer spending has fallen as people stay indoors and people losing their jobs as operations are scaled back or firms closing down. Many companies are going into administration while others are seeking a bailout. So, what's the outlook? Well, investors are currently confused as to the impact of the virus, so initially they reacted with a huge sell-off, but then reversed their decision, thinking perhaps it's not as bad as they initially thought it was. However, as the infection rates show, the virus is spreading and the peak infection rate has not yet been reached for the US or the UK. This, along with record unemployment figures, led investors to reassess and consequently sell off their shares. The markets have also shown huge volatility with large price swings within the day itself. This points to the type of uncertainty which investors are coping with, clearly something new to them. While crashes have been regular occurrence in the markets, the cause, however, that is a pandemic which resulted in direct economic lockdown globally, is quite unprecedented. There are no case studies to study and anticipate the outcome. So what can you do as an investor, especially if you have already invested in the stock market prior to the crash? Well, to start with, don't panic and sell your shares. If you sell your shares during a crash, you are effectively materializing your losses. If you keep your shares until the markets recover, which they will do, you would have simply weathered the storm. Now, this usually applies to a well-diversified portfolio, but if you're stock picking, then you should consider whether there's a risk that the companies might go bankrupt during the period. That's why I'm against putting all your money in a few companies, but instead promote diversification. I've always been a fan of index funds, especially for new investors or those who want peace of mind and great returns. You can see my video about index funds and why they're so great. So if you're not going to sell your shares, what are you going to do? Well, this can be an opportunity to buy stocks at a great value and generate huge capital gains when the share prices go back up. So remember earlier when I showed the gains from the 2008 stock market crash? Well, if you had invested in the Spider S&P 500, then you would have bought it at $76, and prior to March 2020 crash, your stock would have been worth $331. That's a massive 436% gains, or an annualized 14% return, and that's excluding dividends. However, you may be concerned that if you invest some spare cash now, the prices could fall further and you may miss out on further great opportunities. To mitigate this risk, you can drip feed your investments over time. That is, say you have £5,000 or dollars to invest. Rather than simply spending all in one order, you can buy at different intervals over time while watching the stock market. So for example, £1,000 every week over the next 5 weeks. This way you're smoothing out the opportunities and losses during this volatile period. There are other strategies to invest during a crash. If you expect further price falls, you can put your money into assets that tend to appreciate during a recession, such as bonds or gold, then switch to the stocks when the market starts to recover. Obviously, the difficulty here is knowing when the markets are on a recovery path, and that's why many investment professionals are against timing the market in such a fashion. Nevertheless, because markets don't recover overnight but usually stretches out over a period of months to years, some investors are confident that they can foresee a recovery and capitalize on this. In the meantime, they are able to use the market volatility to buy low and sell high. Again, this only works if you can foresee when the recovery has begun. Over the last couple of weeks, I tried this strategy to test how effective I could be at it. I will make a separate video to update you on the progress, but I'll summarize here before the suspense kills you. In short, while I did make some nice gains, I think it's way too risky to recommend as a strategy. I think drip feeding investment, as I mentioned earlier, is the safer approach. In my opinion, and again I could be completely wrong, but I think the worst is yet to come. Businesses are yet to face the worst of the virus and its economic impact. Usually there's a lag between the impact and the result to which the investors react. As more company reports and statistics emerge later, the stock market will react negatively to them, driving the stock prices down further. And many economists are expecting the worst to happen in the second quarter. However, I also believe the economy will bounce back quickly as the pandemic is resolved. In the meantime, I'm expecting a roller coaster ride, so hold on to your investments and let's ride the ups and downs. That's it from me. I hope you find this video useful, and if you'd like to see more content, please like the video and subscribe. Thank you.